You know, for the past 2 years, one single chart has basically dominated all the financial headlines, flashing this huge, bright red warning light for the entire economy. Well, guess what? That signal has finally gone dark. So what on earth does this mean for the bond market and, more importantly, for your portfolio? Let's break it down.
So that's the big question on everyone's mind, right? The market's most reliable recession predictor is gone. Does that mean we're in the clear? Are we finally out of the woods? Or is the story maybe a little more complicated than that? That's exactly what we're going to get into.
Okay, first things first, let's just make sure we're all on the same page here. The signal we're talking about is something called the inverted yield curve. Now, normally, things are simple. You get paid more to lock up your money for a longer time, right? But with an inversion, it's all backwards. Short-term bonds, say a 2-year treasury, suddenly offer a higher yield than long-term bonds, like the 10-year. It's basically the market's way of screaming that it's really worried about the near future.
And listen, this wasn't just any inversion. This thing lasted for over 2 years. That makes it the longest period like this in modern history. The fact that it's finally over, well, that's a massive turning point for every single investor out there.
So what flipped the switch? What actually changed? Well, that brings us to the new rate reality that we're all facing today.
The main character in this story has been the Federal Reserve. After holding steady for a long time, the Fed finally started cutting rates. They brought the benchmark rate down by 69 basis points. That's just a little over half a percentage point. And doing that directly pushed short-term bond yields down, which did most of the heavy lifting to get the curve back to normal. And the result is what you see here, a classic, textbook, upward-sloping yield curve. The 2-year yield is now sitting below the 10-year, which is below the 30-year. This is how things are supposed to look. This is normal. It means investors are finally getting paid again for taking on longer-term risk. And here is the absolute crucial point, especially if you have a savings account or a retirement portfolio. With inflation kind of hovering around 2.2%, these yields mean you're getting a real return. Your money is actually growing faster than inflation is eating it away. For years, all we heard was, Tina, there is no alternative to stocks. Well, that era is over. For the first time in a very long time, bonds are truly back in the game as serious income generators. But look, the end of this yield curve inversion isn't happening in a vacuum. To really understand where we go from here, we need to zoom out, way out, and look at the huge structural shifts that are shaping the global economy, just like JP Morgan laid out.
First up, we are seeing a massive wave of what's called fiscal activism. Basically, governments all over the world facing all this trade uncertainty are just opening up the spending taps to support their own economies. This is a huge change from the last decade of austerity.
Second, technology is accelerating like crazy, but it's really out of necessity. You've got aging populations, slowing migration, labor is just getting harder to find. So to keep growing, companies are being forced to dump money into AI and automation. As one CEO perfectly put it, those who use AI will replace those who don't.
And the third force, economic nationalism, is basically acting like a catalyst for the other two. I mean, think about it. When you raise barriers to trade and migration, countries are forced to look inward. And that just turbocharges the need for domestic government spending, and it pushes companies to adopt technology even faster just to stay in the game. JP Morgan actually has a fantastic name for how all these three forces work together. They call them the silver linings. And it's a great way to think about it, because while things like trade friction and populism create a lot of challenges, they're also forcing these really powerful positive responses in investment and innovation that are literally reshaping the next decade. So, okay, that's the big picture. We've got these huge long-term trends. But what does that mean for us right now? How should we actually think about investing? Let's zoom back in to a super clear, actionable framework for today's market from the experts at Bond Blocks. It really boils down to 3 key ideas. First, use these awesome new yields to generate income and help stabilize your portfolio. Second, be really precise with your credit choices. You want to focus on quality companies. And third, and this one is super important, focus on intermediate duration. Just think of duration as a bond's sensitivity to interest rate changes. The middle of that yield curve is now the sweet spot for balancing risk and reward.
All right, so that's the strategy. Now let's get down to the nitty-gritty. Where might you actually find these income opportunities? So here are a few key areas that really line up with that framework. Intermediate U.S. Treasuries are right in that sweet spot we were just talking about. In the corporate bond world, you can find some really solid coupons in high-quality investment-grade companies, especially those rated BBB. If you're willing to dial up the risk just a little bit,
The higher end of the high-yield market, we're talking BB-rated bonds, can offer coupons up near 6% with historically low default risk. And for a little diversification, private credit is still a pretty compelling option. You know, to really bring this all together, I want to end on this really forward-looking quote from JP Morgan. It's just a fantastic reminder that, yeah, there are very real challenges and shifts happening, but these powerful forces of investment and innovation are creating some pretty significant long-term opportunities.
So here's the bottom line. The old playbook? It's out. The recession warning is off. The yield curve is back to normal, and these powerful new trends are completely reshaping the economy. The old map is gone. So the question now isn't if there are opportunities, but in a world of shifting landscapes, how will you find the silver linings?